I'd like to know more about the task force recommendations regarding the new classification of assets and liabilities.
Okay. Traditionally, assets and liabilities in agriculture have been classified in one of three categories: current, intermediate, and long-term. This three-category classification is somewhat unique to agriculture. The members of the task force believe that more and more people will migrate toward the two-category classification we've just discussed.
What you're suggesting is the classification used in GAAP, or generally accepted accounting principles.
Right. We believe an increasing number of farmers, lenders, and other agri-finance professionals will accept the classification used in GAAP. That is two categories, current and non-current. The definitions for current assets and current liabilities would be as we discussed. However, intermediate and long-term assets would no longer be segregated. Those two categories would be combined.
Why did the task force recommend this change?
Let's ask Dr. Danny Kleinfelter, extension economist at Texas A&M University, who was a member of the subcommittee that recommended the change.
Hi, Danny. Danny, why did the subcommittee recommend going to the two-category classification?
Good morning, gentlemen. The question of whether to recommend the GAAP convention of segregating the balance sheet into two categories, current and non-current, or to go with the three classifications traditionally used in agriculture, current, intermediate, and long-term, was one the task force considered at length. As you already noted, we recommended the two classification system. There were two main reasons for feeling that the migration away from the three-category system is going to occur. First, as asset holdings and the terms of financing arrangements become more diverse and complex, it's becoming increasingly difficult to develop a definition for the intermediate and long-term categories that can be consistently applied to all operations. For example, intermediate term liabilities have traditionally been defined as those with original maturities of less than 10 years. But that definition would mean that a real estate loan with a 5 to 10-year balloon payment would be classified as an intermediate rather than a long-term liability. And second, the intermediate and long-term classifications force certain liabilities, such as deferred taxes, to be segregated in a manner that isn't particularly meaningful. However, since the intermediate and long-term classifications are simply subcategories of the non-current classification, the recommendation of the task force doesn't preclude the use of a three-category balance sheet if the user feels the segregation is substantially more informative.
Thanks, Danny. Before going any further, let's talk about contingent liabilities. First, how about a definition?
A contingent liability is the amount a farmer would owe if a particular event occurred. For example, he or she would likely owe taxes if assets were sold on the balance sheet date.
Or it would be the amount owed by the farmer if he or she co-signed a note for someone and they defaulted.
That's right. These amounts should be included on the balance sheet to give a complete financial picture of the business.
Where do you record contingent liabilities on a balance sheet?
Some people recommend that contingent liabilities for an ongoing business be included in the main body of the balance sheet, while others advise placing those liabilities in a footnote.
What did the task force recommend?
They recommend recording in the main body of the statement such things as deferred taxes on sale of current assets, taxes on capital gains, depreciation recapture, and investment tax credit recapture. They suggest recording in a footnote such things as co-signed notes.
How about personal assets and liabilities? Should they be included on the balance sheet of the business?
If the intent of the balance sheet is to represent the financial position of only the business, then personal assets and liabilities should not be entered on the balance sheet.
I believe most lenders will want you to add a notation or footnote, or prepare a separate balance sheet indicating personal assets and liabilities, or prepare a consolidated business and personal balance sheet to get a complete financial picture.
I agree, Fred.
We've discussed all the major components of the balance sheet and their classifications with one exception, owner equity. How about owner equity?
If we add current and non-current assets, we have total assets. If we add current and non-current liabilities, including the deferred tax liabilities, we have total liabilities. The difference between total liabilities and total assets gives the owner equity of the business. This is the third component of the balance sheet. Assuming the balance sheet has been prepared using market values for assets, owner equity is what is left if the owner sells all the assets and pays all the liabilities.
Before we discuss how to value assets and liabilities, it may be useful to pause for a few minutes to review the concepts presented and to complete exercise 3. We'll be back in a few minutes.